The unrest in D.C. not really bothering the markets this week. Sharon Epperson is looking at that disconnect between Wall Street and Main Street. Sharon.
Morgan, it is really astounding when you consider what people are thinking personally about what they're seeing in Washington and the pandemic. In fact, Politico did a poll that just came out last night saying that 64% of registered voters were worried about the events that occurred at the U.S. Capitol on Wednesday, and yet the market continues to reach new highs. We talked to a number of people, behavioral finance experts, market strategists, as well as financial advisors about what is occurring here, why there seems to be this disconnect between what is happening on Main Street and on Wall Street. And Liz Ann Saunders from Charles Schwab, the chief market strategist there, said that there is indeed a lot of froth in this market, that prices are unsustainably high, and that investors need to realize that what they should be doing is sticking with their plan and not get emotionally involved in what we're seeing in Washington or what people are experiencing at home with the pandemic. So it's a time to kind of reassess where you are, but a very worrisome time for a lot of people, even though they are seeing, those that are investors are seeing their investments go up in many cases.
Yeah, Sharon, I mean, I think Peter Bookfar over at Bleakley really put it very bluntly yesterday. He said perhaps the reason we're not seeing, the markets react, at least yesterday, more to what happened in D.C. is that it really has no bearing on the direction of economic earnings. The economy, here we go, I can speak here this morning, earnings or interest rates. Obviously, the Fed and the liquidity story, I think, is probably playing a role here as well. But the fact that we have so many more retail investors in this market right now, I mean, is there a sense, at least from the folks that you speak to, that maybe they're trading in this market or they're investing in this market without that institutional knowledge, and that's having a role too?
Well, they don't have that institutional knowledge, but they may indeed be following what the institutional investors are doing. When you think about the fact that more than 30% of this market is individual investors, many of them, and particularly new investors, are investing on a digital platform. They're with robo-advisors. They're self-directed, but they're algorithms that are actually making these investments for them. And in that case, they may not be, making any emotional decisions, but going along with what the institutional investors and money managers are doing and keeping their money there. Add to that the number of people that are invested in retirement plans where they're just default investing in a target date fund that, again, takes that emotion out and rebalances based on their age and their retirement date and allows them to take some of that emotion out of the investment proceedings. So those are some things that may be taming the fact that, yes, people are looking at what they're seeing and may be a bit frightened personally, but they're then just following what is happening with institutional investors as well with their own investments and their own money. But it is important that, as we talk to some of the financial advisors and behavioral economists, it's important to stick to that plan. We always talk about it, but this rebalancing, even when the rebalance means that now you're 70 stocks, 30 bonds instead of 60-40, it's time to look at that. And it feels good until it doesn't. So one of the key points that Dan Egan and Betterment made is that this is the time to be aggressive in your saving, aggressive in building that safety net, that buffer, and that emergency fund, so that if you feel that you want to be and you need to be because of what your financial plan is, if you need to be more aggressive, then you can be. You have the comfort of doing that because you've been very aggressive, conservatively saving, so that you can be aggressive in terms of being more of a risk taker with your investing.
Shepard Smith here. Thanks for watching CNBC on YouTube.